Okay, good morning. Happy Monday. Hear a lot of yawning. I feel the same way. Anyway, Friday we have a midterm. It'll cover chapters 1 through 4. I may complete 4 sometime early on Wednesday. If I get into 5, that's okay. You're only responsible for chapters 1 through 4. And a reminder that you are responsible for emails that I have sent you. They're all archived on the web page. Basically, I just want you to read them and pay a bit of attention. If I send you something, it's for a purpose. Usually it has relevance to what we're discussing in class at the time, but it brings in something from the markets this week. In fact, I just sent you an email a couple minutes ago that I'll talk about in a minute, but it's a short one, okay? So on Friday, we were introduced to the exciting area of currency futures, and we saw an interview with Mr. Jim Rogers. Check out his website sometime. He's written a couple great books about investing in foreign countries, and he's made a lot of money trading currencies. The currency markets are in the news today. That was partly the email I sent you. Basically, our president is trying to convince Japan and China to allow their currencies to become stronger, which means the US dollar becomes weaker. So the administration is trying to talk down the dollar right now, the US dollar. So what I'd like to do today is give you an overview of the different contracts that are traded as financial futures, what we call financial futures. And we've already discussed some of these, obviously, but I put them into these 3 categories. We have the currencies that you're familiar with. Hopefully some of you are trading them. On Friday we learned about factors that influence the exchange rate. Okay? It has to do with government policy, it has to do with economic growth, it has to do with interest rate differentials and so on. And then there's a very large market in what we call debt instruments, or a lot of people simply refer to these as the Treasuries. T-bonds. We've discussed T-bonds. There's a large volume of trade in the European markets on bonds as well. And of course the eurodollar, which is a short-term interest rate. And I'll explain the difference in the U.S. Treasuries in a minute. But this market has been very, very active for the last decade or so. And it all revolves around interest rates, and we have different contracts depending what point we are on the yield curve. The yield curve shows you the interest rate against time to maturity. So we have interest rates for 30 days, for 90 days, and for 30 years. And the contracts will pick different spots on that yield curve. And then of course, we have our equity instruments that we've discussed in class. Come in. Play some basketball? And these equity instruments are for the most part, the indexes based on stock markets. And we'll focus on what's going on in the U.S. Normally, I'll refer to the S&P or the NASDAQ index, which is an instrument written on the underlying stock index. So if you look at the price of the December NASDAQ futures, that's a forecast of what the NASDAQ will be in the month of December. Okay? Okay, let me talk a little bit about the financials. As you know, futures markets have been around for many years, 150 years or so, but it's not true for the financial futures. These contracts were introduced in the 1970s, which to you seems like a long time ago, but it doesn't to me. And the first contracts were what's referred to as the Ginnie Maes, which stands for the Government National Mortgage Association. The U.S. government likes to encourage construction of housing in the U.S. That's a big part of our economy, the housing market. And partly to encourage growth in this industry, the government will guarantee home mortgages after they are repackaged. So if, as a homeowner, you go out and borrow money from a local bank or savings and loan, they lend you money to buy your house. They don't hold that mortgage for 30 years or 15 years, however long you're borrowing the money for. You're borrowing the money for 30 years. They're going to sell that mortgage. Okay? So they'll sell the mortgage. These mortgages get bundled. They get packaged together and then sold as a package to investors, both domestic and overseas. And the government will guarantee the investment. So if you buy one of these packaged instruments and all these homeowners fail to pay their mortgage payments, there's some economic disaster, the government will guarantee them. And this is the role of the Government National Mortgage Association. So these Ginnie Mae contracts were introduced, and basically they're long-term futures contracts. Since then, their importance has declined because of the rise of the Treasuries. For the most part, the Treasury bonds. The next year, Treasury Bills were introduced. T-bills are short-term instruments. They're very similar to the eurodollar, except it's the interest on deposits in U.S. banks that's reflected in the T-bill rate. The actual T-bill is a treasury. It's an instrument that's sold by the federal government at auctions. So the government has weekly auctions where they will sell treasury bills to the investing public at a discount to their face value. And this is one way the government raises money. You know, the alternative is bonds. But on the short-term basis, the government will sell these treasury bills, and suppose it has a face value of $1 million. It will auction them off. You buy it for less than its face value. You hold it until maturity, and then you redeem it for its face value. And the difference between what you paid and the face value is your effective interest. And most of these are auctioned 90 days before maturity. So there's a futures contract written on the T-bills, which reflects, as I say, very short-term interest rates, 90 days, sometimes 180 days. And then we have, of course, the T-bonds and the eurodollars that we're all familiar with. But just to give you some idea of the rapid rise of these contracts, you know, back when they started in the mid-1970s, of course, there was no volume in financials. The total volume on the Chicago Board of Trade was 19 million contracts, and it was all either agricultural or metals. Then that rose very rapidly, and last year I have statistics for it, exceeded 200 million contracts in total. Of that, 160 million were financials, so a very rapid increase. This is just one exchange. The big contract on the Board of Trade in the financials is the Treasury bond, a T-bond. Yes?
Is this daily volume?
No, annual. Annual volume. Okay, so let's spend just a little bit of time on the portfolio of treasuries that are out there. So first of all, the federal government raises money basically by issuing these treasuries. And for the most part, these treasuries are then retraded in cash markets or spot markets. And there's a very, very large market, secondary market in treasuries. Of course, if they're issuing 30-year bonds, that piece of paper is going to be around for a long time. That can be traded many, many times. Fact of the matter is, a couple of years ago, the government stopped issuing 30-year bonds because we were in a budget surplus. You all know that that's changed. Now we're in a huge budget deficit at the federal level. So the 30-year Treasuries may come back. Anyway, there are three basic Treasury instruments. There are the Treasury Bills that I just referred to. Those are sold at auctions. And the futures contract that's written on a Treasury bill is for a 90-day instrument. The bills always mature in less than 1 year. I said, the auction might have a 180-day bill, but the contract that we're focusing on at the CME is written on a 90-day instrument, the same as a eurodollar. The interest rate on the eurodollar is also 90 days, or a 1/4 of a year, okay, a fourth of a year. So the bills, the notes are also sold by the U.S. Treasury. They mature between 1 and 10 years. The 10-year T-note is sort of a standard reference. A 10-year Treasury note is a standard reference. And then, of course, the Treasury bonds that mature 10, 15 years. They're not selling 30-year bonds right now, but there's still a lot of these older bonds in circulation that you could buy in secondary markets. As I said, the T-bills are sold at a discount to the face value, and we'll talk about the pricing in a second. I explained how to price eurodollars. It works exactly the same for Treasury bills. The price is discounted from the face value, and so if you look in the Wall Street Journal, the futures price is 100 minus the interest rate or the yield. So if the interest rate is 3%, then the index, the T-bill index at the CME will be 100 minus 3, 97 will be the index. The notes are like the bonds in that they're not sold at a discount from the face value. Instead, they have a fixed payment schedule, a fixed coupon rate. It's either semi-annual or annual. And we talked about a bond with a 6% coupon. That's the standard that's used for the futures contract at Chicago. It's a $100,000 bond with a 6% coupon, which means if you paid $100,000 for that bond and you put it in your safety deposit box, then you would earn $6,000 a year for the next 30 years, right? If you paid more than $100,000, you still get paid $6,000 a year, so your interest would be the same in terms of the dollar amount, but the rate of return would be less because you're paying more than $100,000 for it, so the effective yield would be less, and therefore the price of the bond varies inversely with the yield, and we discussed that one day on the blackboard. And notes are the same way. Treasury notes are exactly the same way. And then you have there are a lot of other types of bonds around, what's referred to as muni bonds, which are local governments that are issued. There are also some futures contracts that are written on packages of these muni bonds. Usually they pay a slightly higher interest rate because there's a little bit more risk attached to buying bonds from a municipality, because a municipality or a county could go broke, right? About 10 years ago, Orange County ran into some major financial trouble. So those bonds will carry a higher interest rate. And then, of course, you have the eurodollars, which we've talked about, which, again, I'll just repeat myself. The eurodollars refer to deposits of U.S. dollars in foreign banks. Normally, we refer to them as European banks, and you earn an interest on that money. It's the old greenback. It's a U.S. dollar. But you're earning an interest in a foreign bank that's not controlled by U.S. banking law, so the interest is always a little bit higher than what you could earn at home. And that's a very popular futures contract reflecting short-term interest rates. Yes, question back there.
Is there a name for the discount or the semi-annual interest payments that T-bills?
The bonds, you mean?
Notes and bonds?
Just a I refer to it as coupon rate. Yes?
What are notes exactly?
Treasury note. It's all these instruments they're just a piece of paper. Nowadays it's electronic, right? You don't even see it. It's just goes across on the computer. But basically they're promissory notes that are sold by the government to raise money. You buy it. and you hold it. It doesn't have the maturity that a bond does. Treasury notes are typically 5 or 10 years, and basically you're lending the government money, and you earn a rate of return that's very low risk, and that rate of return, as you know, will vary with market conditions. Because if you put your money in a bank in London, you're not protected by U.S. banking law, okay, as an investor. So if you deposit your money with Bank of America and you wake up tomorrow morning and you read in the paper the Bank of America has gone broke, you are protected under U.S. banking law. So your deposit is protected. You'll get your money back, in other words. Well, not for a foreigner, no. I mean, you're on your own, right? I'm not saying that England doesn't have those laws, but it wouldn't apply to you. Yes?
Is the interest rate on eurodollars standardized, or is it different from country to country?
Question is the interest rate on eurodollar standardized or different from country to country? In the spot market, it would differ, but when we're referring to eurodollars, of course, we're always talking in the context of the futures contract. So that's a standardized rate, and it's based on a rate in London called the LIBOR. It's a London interbank rate, overnight rate. So it's based on the LIBOR index, so it is standardized. But you're right that if you put your money in a bank in Malaysia, or your U.S. dollars in a bank in Malaysia, or a bank in Moscow, or a bank in London, you could probably fetch different interest rates, right?
When you buy a long-term bond electronically,
Yeah.
what sort of tangible thing do you have as a record to show that it's yours?
You just have a record. To be honest, I don't buy bonds, but as far as I know, if you insist, you could have a piece of paper, okay? But essentially, you'll get a statement. Usually, you'll buy them through a brokerage firm. You can buy them directly from the government. So you would get some sort of electronic record that you might keep electronically or print out. It's just a piece of paper. Yes?
Often do people get burned by investing like eurodollars or money in foreign banks?
Well, the one question was referring to maybe unstable countries politically. So if you're investing in a very unstable, I wouldn't put my money in the Bank of Afghanistan right now, for example. So I think there it's highly risky. But if you're depositing it in Europe, it's very stable. The LIBOR rate is something that you can count on. So I mentioned the differential in the interest rate. It's not huge. It's very small. But if you're interested in a safe investment, short term, and you're going to park some money short term, that's a nice option, is to put it in the eurodollar market, because you'll earn a little bit more for your money. And it's maybe not 100% safe, but it's 98, 99% safe. But this is it's a very complicated market, actually, because there are so many instruments floating around and so many different bonds with different maturities and different coupon rates. It's all very confusing, but it's a huge market, and one that's growing. It's attracting a lot of overseas interest. Let's see, I'll get to that in a second here. But I think these are really good questions because it just illustrates how complex this market is. And of course, with the futures contract, we boil it down and we standardize it, so there's just one instrument that's being traded. But most of these debt instruments have the characteristics that I've already touched upon in different ways. They all have a face value, they all pay interest, they have a maturity, the terms are very specific. That's why you can easily write a futures contract on them. I've mentioned the secondary market already. Let me go to this slide, and then I'll just refer to this article that I emailed you this morning. So why did this industry take off? Since the late 70s, call it the early 80s, really in 20 years, why has this come to dominate the futures market? Well, there was a major shock in the early 1980s when interest rates went to double digit. So basically the short-term interest rate was 20%, 21%. Okay? Today it's 1% or 1.5. So it's hard to believe, but it's true. So interest rates went to double digit, became very volatile in the early 1980s, and that was a very expensive lesson for a lot of financial firms. If you're in the banking industry and rates spike up to 20%, that can be very costly. So a lot of banks, actually, savings and loans, went broke during that time period because they were left unhedged. As a result, a lot of the financial community now uses the futures market for hedging purposes because of interest rate volatility. It's, you know, we've discussed the crude oil market, we've discussed the cattle market and other markets. This is no different. The interest rate is an important cost item for many firms, but clearly if you're a financial firm, the interest rate is the driving force with regard to your bottom line, and so there's a lot of exposure to interest rate volatility. We've seen a lot of volatility in the last few months on the long term of the yield curve, the long-term bonds, and this attracts a lot of attention from hedgers and speculators. The point that I was anxious to mention was the fact that these are now global assets. We've talked about the U.S. bond market. When the government sells bonds, actually a large share of these bonds are purchased by foreign banks. Right now, if you look at the Bank of Japan and the Bank of China, they are two of the largest buyers of U.S. bonds. Also, the European banks hold a lot of U.S. bonds. Last time I checked the figures, something like 35% of the bonds were being purchased by either Japan, China, or some of the European banks, which is sort of interesting. It gives some people cause for concern, but it's simply a reflection of the fact that we are now in a global economy. China has a very large trade surplus. They're exporting more products than they're importing, so they have very large foreign exchange reserves, right? They're exporting products, earning US dollars for those. That exceeds the number of dollars they spend on imports, and so they have all these US dollars. What are they doing with them? Well, they're sitting on a big pile of US dollars, plus they're using this currency to buy bonds. So as they come into the market, they bid up the price of bonds. That drives down interest rates, which some people feel is good for the US economy. You can take out a mortgage on a house. You get a 30-year mortgage for 6% or 7%, and you can thank the Bank of China, because if it wasn't for them coming in and buying up the bonds, you'd be paying 8%. Okay? So that's good, unless they change their mind, of course, and start reversing and start pulling out of the market. And so if they go dead in the water and stop buying the bonds, okay, then the price is going to fall very rapidly, and interest rates are going to rise. And there's a lot of concern in the market right now because our president's over in Asia. He's telling Japan and China, actually, that their currencies are too low in value. They have to increase the value of their currency. In the case of Japan, they're keeping the yen down through open market transactions, basically through moving money around in the global marketplace. In the case of China, they have a fixed exchange rate, so it would require a change in government policy to change the rate, but he believes that the fundamentals are such that the exchange rate is too low. It needs to increase in value, which if that were to happen, would strengthen their demand for imports from the U.S. And of course, then the U.S. dollar is going down in value, so it would weaken our demand for imports from Japan and China, and basically trying to correct this trade deficit that we have with most of Asia. That's really where the administration is coming from. So they're putting pressure on these banks to pull back, which means that they would decrease their purchase of bonds, the price would fall and long-term rates would go up. So it's a bit of a knife edge, because then if rates start going up, then people stop buying houses and the economy might start to slow down a little bit. The email I sent you this morning was kind of interesting for a couple of reasons. One is just to illustrate how sensitive these markets are to news or statements by government officials. Okay, I give you an example in the book of where President Bush gets mixed up between deflation and devaluation. He did it again recently. He started talking about China's monetary policy, and today nobody really knows if he really meant exchange rate policy or monetary policy, and they're trying to sort this out. With him, you're just never quite sure. But recently he's been talking about he needs to talk to China about their monetary policy, but I think he meant exchange rate policy. This story came out today. Our Treasury Secretary, John Snow, who was in Asia a week or two ago trying to talk the Japanese and China into inflating their currencies, he was in Europe over the weekend, Mr. Snow, and he made a statement that surprised the markets. So the markets reacted to this statement on Friday and over the weekend. And he said something like, higher interest rates are an indicator of a strengthening economy. So he's talking about the U.S. here. Okay? And our rates, at least the short-term rates, are lower than they have been since the 1950s. So short-term rates are very low now. He says higher rates are an indication of a strengthening economy. I'd be frustrated and concerned if there was not some upward movement in interest rates. So this is coming from our Treasury Secretary saying he'll be frustrated if rates don't go up. And of course the markets reacted. There were a lot of sell orders going into the Treasury market, which sent interest rates higher. But now the White House is saying, well, that's just John Snow talking. It's not our policy. And he's just making this generic statement that if an economy strengthens, rates will go up. So whether he was or wasn't, the markets reacted to that. But they're softening a bit today because they're not quite sure if this is government policy or not, that we want our rates to go higher. So it's all part of this marketplace now being a global marketplace. Prices are highly sensitive, as I just explained with this article, right? It's a highly liquid market. The videotape on Friday told you that the currency market was the largest market in the world. I think that's true in terms of value of trade per day. The currency market is the largest in the world, but the U.S. Treasury market is not far behind. It's a highly liquid market. So it's very easy to buy and sell Treasuries, and there's a very short difference between the bid-ask spread. That's what a liquid market means. Okay? Anybody else see this story about Mr. Snow? Okay. I want to spend some time explaining an important concept in these financial markets that has to do with something called the yield curve. Okay? The yield curve is much talked about in the financial markets. If you go to the class website, I have some other links to sites that, let's say, focus on the bond market, for example. There are 2 or 3 there that take you to sites that have a lot of information with regard to bonds. You might want to look at that this week and become a little bit familiar with the yield curve. Mr. Snow's remark was taken seriously by the marketplace because we're now sitting with a yield curve that we haven't seen for probably 10 years or so, and one that's very steep. The yield curve basically plots the yield, right, or the interest rate against time to maturity. I have a slide of it coming up, but I'll just show you. So you have, very, very short-term instruments, right? So you have 90 days. You have 1 year. You have 10-year. And you have 30-year. So we look at these instruments and their maturities, their yields, and we have our yield curve. The Wall Street Journal every few days actually gives you a picture of what the yield curve looks like, and you can easily find it on the website too. So normally the curve looks something like this. It's upward sloping, meaning that instruments with longer maturities pay higher yields. They have higher interest rates. So I want to spend a little time explaining why the curve normally looks like this instead of this, although once in a while we see it downward sloping. But normally it's upward sloping. And there's an economic explanation for that. And why are we interested in yield curves anyway? Why are they of interest? Well, obviously, they explain the linkage between the short-term rates on T-bills and long-term rates on bonds, but they also have a lot to do with market expectations. They have a lot to do with market expectations. And let me try to pull up some examples here for you. Well, I better go over this slide. So as I said over there, they're normally upward sloping. So a 30-year bond will have a higher interest rate than a 10-year note, and the 10-year note will have a higher interest rate than a 180-day T-bill. The yield curve is of great interest to financial traders given that it changes its steepness as the market marches along. Once in a while it's inverted, going down, but the curve is often changing its steepness. And that is the long-term rates are changing vis-a-vis the short-term rates. If you look at what's happened just in the last few months, the short-term rate has remained unchanged. Okay? The short-term end of the yield curve, this rate here, down here, that is set by the Feds. Okay? So the U.S. Federal Reserve can influence the short-term interest rates. They have something called the Fed funds rate, which is an interest rate that banks charge one another for overnight deposits. And that's an instrument of government policy that can change the Fed fund rate. And as I said, that rate is now the lowest it's been since the 1950s. So it's 1%. And it's been dropped in a very straight line fashion since I think January of 2001 until October of 2003, that rate has been pushed down, and it's only at 1% now, which is very, very low. This end of the yield curve is not controlled by the government. It's really the market that controls this end of the yield curve, really into even the mid to high end range. So that's why the yield curve is of interest, and that's what Snow is talking about. He said, I would be surprised if rates didn't increase as there's sign of a strengthening economy, which means that as the economy strengthens, he would expect to see this end of the yield curve increasing, so maybe it would become steeper. Okay? if the rate doesn't change at the short end, but it increases at the long end, and that's exactly what's been happening, okay? So here at 1 year or less, and here we're at 10 years, and here we're at 30 years. A couple of months ago, the curve looks something like this. And what's happened since then, basically, is it's steepened. If you look at December Treasury bonds, they were trading at 120 basis points, 120% of par in June or July of this year, and they're now down to 107. So long-term rates have gone up in the last few months. If you know anybody that's renewing their mortgage, you know they missed the bottom of the market. Mortgage rates are higher now than what they were a couple months ago. For a typical house in the city of Davis, if you missed that market, the present value is significant. It could be $100,000 if you'd refinanced in July instead of now over the course of the loan. So the yield curve has steepened, and that's what Snow was talking about. And why do you suppose it's steepened? It's steepened because the market thinks that there's going to be economic recovery in the U.S. The market is telling us that the U.S. economy has some strength. So far, the Feds haven't budged. They've kept the short-term rate low at 1%. The reason they dropped the rate so low was to stimulate the economy. Low interest rates are good for the economy. People will borrow money to buy a new boat or go on vacation or whatever they do. And this stimulates economic growth. And so that was the whole reason that the Feds were pushing it down. So it seems to have worked. Now there are these indicators that we've been reading about that suggest there's economic growth. So the long end of the curve is coming up. And so what Snow is really referring to is that maybe it will flatten again. So maybe we'll go to something like this. Right, so this was July. This is October. And maybe by December or January, short-term rates will go up, which has to do with federal open market policy. That depends on the federal government. They might raise short-term rates. That's why the market's reacting, because he's hinting that rates should go higher across the board. Any questions on what's happening with the yield curve at the present time? So there is considerable information in this little relationship. We can really understand what the market is telling us if we watch the yield curve and how it behaves over time. The fact that it's steepened in the last few months is a very strong signal of economic recovery. It's steeper now than it's probably been in a decade. As the slide says, if short-term rates are really high, so if the Fed got that short-term rate up to double digits, then we might have a negative slope. In 2000, the curve was negative. And that's also a signal. When we see a negative or downward sloping yield curve here, that's a signal that the rates are headed lower. The short-term rates are headed lower. And it's really an indication that there's a slowdown in the economy. And so for the economy to pick up again, rates will have to fall. So we have a steep slope now. As I said, it was 10 years ago since we've seen it this steep. So here's a couple of pictures for you to verify that it actually becomes negative. That was the curve 3 years ago, September 2000. Hard to believe, right? the rate was 6.5%, and now it's 1%. 2 years ago, they got it down to about 2.5 on the short end of the yield curve. Okay, huge difference in 3 years in terms of short-term interest rates. So you could imagine what that fall in the interest rate has done for economic activity. And interestingly, if you compare the yield curve in 2000 with 01, those long-term rates are very similar. Right? The curves cross out here, so the 30-year rate was very similar at about 5.5%. And this is what the curve looks like now. Your book has one from August, but last night I updated that from the Wall Street Journal. So this is what we're looking at. It's not much different than the one in your book. It's a little bit steeper, I think. Basically, on the 30-year, we're just over 5%, so very similar to those earlier graphs. As I said in July, that 30-year rate was well below that. So the curve has steepened since then. The short-term rate was identical. It was at 1%. Okay? Any questions on the yield curve? Well, at least you should know how to draw one if I ask you that question, or ask you a little bit about its shape. So I mentioned that normally it's upward sloping. Well, why is that? And there is some debate about this, so I'm not going to pretend there isn't. But for the most part, it's fair to say that it's normally upward sloping because of something called liquidity preference. And that simply means that everything else held constant, if someone is lending money to the federal government, they have a slight preference for liquidity. So if they're going to lend money for 30 years, it's going to be tied up for 30 years. Right? You buy this bond, you hold it for 30 years. I mean, you could resell it again, but its price is going to change. So if you're lending me money for 30 years, you're probably going to charge a higher interest rate than if you're lending me money for 5 years or even 1 year. And that just gets at the fact that everything else held constant, most investors have a preference for liquidity. In other words, if you're tying your money up in an investment for a very long time period, in all likelihood you'll ask for a higher interest rate. So if I wanted to borrow money from you for 90 days, you might charge me 1%. If I said, well, I'd like to borrow that same amount of money for 5 years, you'd say, no, I'm not lending it to you for 5 years for 1%, because there's a lot of uncertainty over the next 5 years. Rates could go higher. So if you want to borrow it for 5 years, you need to bid it up, get that price up. I might charge 3%. So that gives you an upward sloping yield curve. It's a preference for liquidity, which means that given the uncertainty in the marketplace, you just don't want to tie your money up for a long period of time. We have different yield curves, of course, depending on what assets we're referring to. This just shows an example, corporate bonds. So it's not only government that issues bonds, but also corporations, General Motors, so on. They'll also sell bonds. The yield curve looks the same. If you're lending General Motors money for 30 years, you want a higher rate than for 15 years. But you'll also, so it'll be upward sloping, but it'll also lie above the Treasury slightly because there's more risk attached to those bonds. Okay? So if we had a graph of the California bonds, according to Arnold, we're almost junk. He was calling them junk bonds, but we're not quite there yet. But it would be much higher because it's a very risky investment now, buying California bonds, because the economy here is in trouble. Okay, that's the story on the yield curve and what's going on in the market recently. And I'd like you to pay a little bit of attention to that this week. Maybe take a position in StockTrek as a result, because it ties together many different factors here, especially given that our president's over in Asia right now talking about these very issues. We've got international differences in interest rates. We have international investment, a lot of investment from Asia into the U.S., into our money market. So that ties together policy on currencies, the interest rate, and also the stock market, the stock indices, because we're talking about economic growth here. So I guess if people thought Snow was right, maybe you'd buy some of the stock indices if he knows something you don't, and this economy is going to heat up and really start to cook in the next 6 months, then the stock market should continue to rise. What happens to the dollar? That's a very interesting one, because the administration is trying to talk the dollar down. But if in fact our economy does start to cook and improve, then maybe the dollar will maintain its strength, okay, and it won't weaken. So that one is a little harder to call. Yes.
Why would someone buy bonds? It looks like the yield on a bond would not even equal the inflation.
Inflation is very low now. So the question is, why would anybody buy bonds? Well, you'd be surprised. There are a lot of investors out there who are highly risk averse, and they won't touch the stock market. It's either keep your money under the mattress or buy bonds. So there are lots of investors who buy bonds. And right now the rate of inflation is, I don't know what it is, 1% or less. And the yield on long-term bonds is still over 5%. So
That's 5% over the course of 1 year or 30 years.
well, as long as you hold it, right? If you pay par value, right now if you went out and bought bonds, you could earn around 5%. I think it's just a bit less than 5%. Yes. Yeah. Uh-huh. Yeah. And then of course the price of that bond will change as interest rates change, right? If rates go up, then the value of that bond is going to fall. So then your asset is worth less money. But there's also a lot of money that shifts between the bond market and the equity market. And a year ago there was a lot of a negative sentiment towards the stock market, right? We had our bubble burst, the stock market was down. I mean, a lot of people said get out of stocks, get into bonds. And you saw the bond market rise rapidly last year, right through till June. And clearly that had something to do with money flowing into the market. It had something to do with money from China and Japan and Europe flowing into the market, pushed that price up. And all of a sudden the price of bonds got up here and boom, they turned and came down very quickly this summer. So it's a market where you see a lot of volatility, and some people buy bonds not to hold them for 30 years, but as an alternative to keeping their money in the stock market or under the mattress, with the intention of moving it back out again in a year or so. Okay. I guess that's enough for today. I'll see you Wednesday.